Good morning, everybody. Good morning, good afternoon, good evening. We know that some people in our audience are joining from different part of the country and overseas. So welcome to AGAR Global Council, Business Council. And we are very happy to welcome you all and to share today a wonderful program by one of our friends, an amazing professional. Her name is Alicia Castellanos. Today we will be addressing and give an update on tax implications of foreign investments in US real property. It's basically what every realtor should know when working on a transaction involving a foreign seller. I just wanted to introduce and tell you a little bit about Alicia. She is the CEO and founder of Global Taxes LLC. Alicia provides personalized U.S. tax advisory and compliance services to high net worth families and their advisors. She has more than 17 years of experience. Prior to forming Global Taxes, Alicia founded and oversaw operations at the boutique tax firm, worked at the prestigious global law firm and CPA firm. She specializes in U.S. tax planning and compliance for non-U.S. families with global wealth and asset protection structures, which include non-U.S. trust estates and foundations that have a U.S. connection. Alicia also specializes in foreign investments in the U.S., and other U.S. real estate properties, assets, pre-immigration tax planning, and expatriation matters, U.S. persons in receipt of foreign gifts and inheritance, foreign accounts and asset compliance, offshore voluntary disclosures, FATCA registration, and foreign companies wanting to do business in the United States. She is fluent in Spanish and has a working knowledge of Portuguese. She is an active member of the Society of Trust and Estates Practitioners, the New York City Bar, the New York State Society of Certified Public Accountants, and the American Institute of Certified Public Accountants. Alicia was awarded in 2020 with a prestigious NYSS CPA's 40 Under 40 Award. She was selected as someone that has notable skills and is visible, making a difference in the accounting profession. So with no further, I just want to say thank you so much, Alicia, for being with us today. It is an honor to have you. Thank you for your friendship. And we're looking forward to hear once again and all the knowledge that you had to share.
Well, thank you very much, Emmy. I'm really happy to be here among friends, new and old, and I will try to make the best of this. We only have an hour, but I will probably speak for 45 minutes and then take some questions. And if I may just ask Emmy or Kathleen, if it gets to 45 minutes, just let me know. I did put my alarm just in case. But just in case it doesn't ring or for whatever reason I miss it, just if you can give me a heads up, that would be greatly appreciated. Thank you.
We will appreciate if everybody in the audience keep themselves in mute until the 45 minutes. We will open up for questions and answers at the end of the presentation.
Okay, great. I'm sharing my screen. Can everyone see my screen?
Yes.
The first slide says global taxes, and then we are at the next slide, which is like the map of the US. Do you see that?
Yes, we do.
Okay, great.
Thank you.
Okay, well, thanks again. So like Emmy, the name of the presentation, Global Class, and I love that it says Global Class because the name of my firm is Global Taxes, so it's really relevant to what we have. What everyone here is doing, and also the world is becoming more global, right? I mean, people are able to travel more. Right now with the pandemic, not so much, but even just doing Zoom calls. I mean, we could have people logging from anywhere on a Zoom call at any time. So we are very, the world is a global world, and especially in the United States, we have a lot of interest from investors from overseas to come and invest in the United States, right? And so why is there so much interest? And you know, I was surprised to learn not too long ago that the United States is actually considered a tax haven. And I think it was a few years ago, maybe 5 years ago, there is a list, and I forget who puts out a list, but there's a list that's compiled, I think, from an organization in the UK, where they list the tax havens in the world. And I was surprised to see the US was one of them. And guess what? We keep moving up the ladder, basically. You know, we were probably at number 10 at one point. Now we're among, you know, the first 10. And why is that? Well, the United States, people are attracted, investors are attracted to come to the United States because they can, when they set up entities and they buy property here, they can do that anonymously. They don't have to, you know, there are ways that they can really maintain anonymity and invest in the United States. And so that's what they do, and that's why, one of the reasons why it's considered a tax haven. Another reason is there is something called, in the world, there is something called the Common Reporting Standard. And what that is that's, I mean, to put it simply, it's an agreement that the countries have amongst themselves to share information about who is investing, or who has assets in one country and in another. And so these countries share information about the investors, right? And in the United States, we don't have that. We haven't signed up to the Common Reporting Standard. And because of that, a lot of investors want to come to the United States and invest here because they don't want they don't want to have their investments known back home. They don't want their home country to know that they have investments here. So that's one way that they can protect themselves. But you know, there are other reasons. The United States has in general, whether the economy is good or bad, there's always investment here, and that's because we always bounce back, right? Our economy always bounces back. It may take some time, but it does. And then also we have laws, and those laws are respected. I mean, we do have eminent domain, which is where the government can come and take your property away, but that's not you know, that's not as common as in other countries, where in other countries the government really can and has taken away people's properties. And so the investors, the foreign investors, really like that. They really like to know that their investment is going to be a safe investment. And also in general, you probably know better than I, investments in real estate is more of a long-term investment, right? And these appreciate over time. And in the United States, we have seen a trend of appreciation, and that's what the investors like as well. So why would they hesitate in investing in the United States? Well, we do have a lot of taxes, you know, and taxes, all kinds of taxes. There's real estate taxes, and that depends on where the property is located. We have income taxes, so the property is rented out. It doesn't matter that they are non-US people. If they are renting out property, they will have to pay taxes, or maybe at the end of the day, they're not making a profit, maybe not pay taxes, income taxes, but they will have to report their income taxes or their rents to the US, to the IRS, and also depending on the state, may have to file state income taxes. And I want to pause here a little bit, you know, and stay here for a little bit, because what happens is the government, if you have an investor who has property that they bought to rent out, and they tell you, or you tell them, or you know, nobody knows whether they have to file an income tax. If they're generating income from a property physically located in the United States, they're required to file an income tax. And that's important, because when they file an income tax, they can make an income tax return, they can make an election to take deductions. And those deductions are depreciation, which is one of the largest deductions, maintenance fees, and any other, legal, even bookkeeping and accounting fees, any reasonable deduction that would be related to the rental property they can take. If they do not file income taxes and the government comes to them, the government is going to assess taxes on the gross rents. They won't be allowed any deductions. So, in general, from what I see, clients may have a rental property, and because they have so many deductions, especially depreciation deduction, they end up not having to pay any tax because it's really just a reporting requirement. But if the government comes to them and they haven't been reporting anything, they will not be allowed any deductions, and they're going to have to pay taxes. Okay, so moving on to the next tax, capital gains tax. That is when a property is sold and there's a gain on that property, or there may be a loss, but capital gains tax is on the actual gain of a sale of a capital asset. And so we have different rates, 15%, 20%, well, 15%, 20%, that will be at the individual and trust levels, and then 21% is the corporate level. And I will speak about how to hold or how to buy, or how investors are buying property, or recommendations for them to buy property, in what, how to title these properties. And so and these rates, the 15 and 20%, are rates that are long-term capital gains rates. And then the 21% is a corporate rate. It doesn't matter whether it's short-term or long-term. And then also Ferpta, right? Ferpta is in the name of our presentation, but basically it's a well, I'll tell you what Ferpta stands for. It stands for Foreign Investment in Real Property Tax Act. It used to be 10%. There's a withholding requirement if you have a foreign investor and they're selling property. There's a requirement imposed to the buyer, actually, to withhold a percentage of the gross sales price. If, for example, the gross sales price is more than $1 million, the withholding requirement is 15%. It used to be 10%, but it's 15%. It could be 10% if the property is being sold for less than $1 million and the buyer is going to use it as a residential property. But normally it's 15%, and we'll speak more about that in a few slides. So what other taxes do we have? We have transfer taxes, which many of you are familiar with. When you go to a closing and you have documentation and everything's being done, that's when the transfer taxes are calculated and the paperwork is done, the tax return is done, and paid. And then we also have gift and estate taxes. And so gift and estate taxes we have to be careful with, because those are very hefty. I mean, these are at 40%, and there is an exclusion, right, an exemption of $60,000. So I'll speak a little bit more about that in a few. Let me change the slide. Okay, so when investors are coming to the United States, they, one of the decisions that they have to make is, okay, well, or maybe they don't even know, right? It would be interesting. It would be good for us to let them know, hey, if you're not a U.S. person, maybe you need to consider how you want to own this property, because what happens is when non-U.S. persons own property in their own name, and let's say they die holding it, and now that property has appreciated in value, or even if it hasn't, let's say they buy it for $1 million and they die, maybe a few weeks or days or a year even after they buy it, that property, the fair market value of that property is going to be subject to an estate tax, and that estate tax is 40%. So they're going to have, $1 million. I'm just making the numbers easy. but $1 million times 40%, it's $400,000. So that's almost 50% of the value of the property. And if that's what they paid for, I mean, they end up paying $1.4 million. And who's going to be paying for that? Well, the heirs. They are the people who their children, maybe their spouses. So it's really important that the foreign investor plans ahead of time. And if you know, and as since you will be one of the main, I guess, the first points, or one of the first point persons to be assisting them, and maybe they don't know, I think it will be you know, important for you to let them know, hey, I know you're not a US person, but you know, and I really want to help you and help you buy that perfect investment that you're looking for. But you know, you should consider a few things, right? And maybe if you don't know what they are, you know, I'm happy to speak with them, or have someone that you trust speak with them about the tax considerations. Because what I find a lot is clients come to me and it's at the end when they're selling property, when they tell me, well, my broker didn't tell me, or nobody told me, I didn't know. And then it's kind of like I feel that they start blaming, you know, the broker or if for the tax situation that they didn't understand and nobody explained to them. So I think this will be a good opportunity for you to become a valuable resource to them, right? And I think they would appreciate it very much, because it's not just a matter of selling something, but being a resource to these clients, and so that you can have repeat business from them, from their family members, their friends. So some things to consider, right, when they're buying properties. Do they want to, like I said earlier, preserve anonymity? Are they buying the property to rent it out, or to use it for personal use? They need to also consider the estate tax, right? That I was talking to you about, the gift taxes, and also the income tax implications. You know, every depending on how they own the property, the income tax is definitely going to affect them, and they need to understand, well, if you buy it under your own name, these are going to be the taxes, and if you buy it under a company, these are going to be the taxes. So you know, it will be good for them to understand that first, because I do see a lot of times clients buy properties and then they just kind of let them be. They may be renting them out, but they don't understand, or nobody has explained to them that they have to actually file tax returns. And then if they don't, they could get in trouble. And so that's important, right? Let me go to the next slide. And I mean, these are just a few questions investors ask themselves to determine how they want to own a property. I'm not going to go over all of them, but as you can see, some of them are they going to own this by themselves, or are they going to have other investors with them, or is it going to be for personal use or business, etc. Okay, so we are at the point where the investor is buying property. They're determining which option, which way to own the property, and then the next step would be to actually form the structure and acquire the property. And I'm sure that you have seen a lot of clients where they are telling you, well, I'm buying the property in my company's name, or I'm buying my property, I'm setting up an LLC, and I'm buying the property through an LLC. A lot of clients, especially clients from overseas, think that buying property or just having an LLC is a cure-all to all of their problems, and that's not always the case. So an LLC, it's good. It facilitates, sometimes it facilitates purchasing property in the United States, opening up a bank account, because we have a US entity. But if you have a non-US person that owns a US LLC, that's right there, that still does not protect that non-US person from being subject from having the asset, the property being subject to the U.S. estate tax upon their demise. That also would require them to file special paperwork, special tax return disclosures to disclose that they are not a non-U.S. person and that they own an LLC, and then they're going to have to disclose the transactions between themselves and the LLC. So say, for example, they just formed the LLC this year, that's going to be reportable. It's not going to be taxable, but it's going to be reportable. And by the way, if that's not done, and the penalty is $25,000 per year. So, you know, this is something that's it's pretty new. It's been around since 2017, but I still find clients who tell me, "Oh, nobody told me this. I wasn't aware," and they get very, very upset, right? Because they want to do the right thing. They want to make sure that they comply, especially in the U.S. I think the U.S., especially the IRS, has done a very good job in instilling the fear of God in people, right? I mean, nobody wants to mess with them. So especially non-U.S. people, foreign investors, they're like, I'm not messing with the IRS. I'm not messing with the tax stuff. I want to do the right thing and comply. So, and then when they hear about the penalties, they're not happy at all. So they get very anxious. And you know, not that we want to scare them, but I haven't seen the penalties, although they're there. They haven't been really, I haven't seen them imposed on these kind of entities, but they're there, and the government can, you know, turn on the switch at any time and start really imposing them. Okay, so I'm going to continue to the next slide. So we were talking about how are investors, you know, buying property, and like I mentioned earlier, NRA, just so you know, stands for non-resident alien. It's really the non-resident investor, right? They could buy property in through a U.S. LLC, like I was mentioning earlier. U.S. RPI, that stands for U.S. Real Property Interest. So maybe that, you know, again, you have a client, they're buying property through an LLC, and then they have a U.S. Their property underneath that. Again, that's fine, but that doesn't protect them. If they were to die, their heirs are going to have to pay an estate tax. They are also going to have to file while they are alive and having this set up. And if they have, let's say they have transactions between themselves and the LLC, what will be a transaction? Well, they are, let's say they open up an account, and now they fund the LLC, and that LLC is buying the property. That's a transaction. Let's say that they have to pay maintenance fees, and the bank account doesn't have the funds. They fund the LLC's bank account again. Or say, for example, they pay directly. The non-resident alien investor pays the fees directly. That's reportable as well. So, you know, you have to be careful. There are many reportable transactions that would require a form. It's a form 5472 that would need to be filed with the IRS. And that, again, there's nothing taxable on that form, but it's reportable. You're going to have to report and disclose those transactions to the IRS. All right. So I'm gonna share my slides with you, and you can read this, but I'm just gonna skip this. But I guess something that would be relevant to our topic today is Ferpta, right? Ferpta in this situation, in this setup, will apply, because Ferpta applies when you have a non-resident, non-US investor selling US property. So in this case, if the non-US person, investor, decides to sell their property, they will be required to have Ferpta withholding, and the buyer will be responsible for that. And why the buyer? Well, the buyer will be responsible for withholding because they're the ones that are staying in the United States, and the government can really go after them if that doesn't happen. You know, once the seller is gone, and if it's it's a non-US seller, and let's say they have no more assets in the United States, the government can't really go after them they are gone. Once they sell their property in the US, they're gone. So this is why the requirements to withhold is imposed on the buyer. And so whether you are representing the seller or the buyer, it's important for you to understand this. And so, for example, what's the withholding again? It's 15%. But let's say, in this market, and maybe not so much now, but before, let's say last year, there were some sales that were being done at a loss, right? And so why would they have to have withholding of 15% of the sales price to pay the Ferpta withholding on a loss? Well, the IRS understands that, and there's a mechanism that we can request that there be no withholding or even a reduced withholding, right? But in order for us to be able to do that, we would need to apply, and the application has to go in before the closing. And what normally happens, so say, for example, I'll tell you this. I have a client, he bought his apartment for, say, like $5 million, and he sold it for like $4 million, like in 2020. I mean, he had a loss, a real loss, right? And so the withholding would have been 15% of $5 million. That's a lot of money, more than he would have paid in what he was required to pay for capital gains taxes. And by the way, there was no capital gains, so capital gains taxes are zero. So in that case, we applied for a reduced withholding certificate so that the IRS could see that there was no gain on this sale and not require the Ferpta withholding. And that's a process, and it takes time to obtain. So this is why, Ferpta is a requirement, but there are ways that we can work and try to mitigate or make the process a little better. I'm going to continue to the next slide. So I'm going to skip this, but you can read it when you get a chance. Pros and cons. Okay. These are U.S. tax filings, which I'm not going to go over much in detail because it gets very technical, but there are some tax return filing requirements if that's first set up, if the property is being rented, or even if it's not being rented, right? Whether it is rented or not, if a non-U.S. person owns a property via an LLC, and what I'm talking about is one single person owning, one single non-U.S. investor owning property via an LLC, there are some requirements. This form 5472 is required, and that's the one that has a $25,000 penalty. Okay, so sometimes clients buy property, non-U.S. investors, and maybe their properties is worth less than $1 million. When that is the case, and they still want to protect themselves from being subject from leaving a U.S. tax problem with to their heirs, sometimes I recommend that they just take out. And by the way, I'm not an insurance expert, but this is a solution that I find some clients like, because it's practical and it's inexpensive. Depending also on their health and the coverage, but basically term life insurance could be a good solution for some clients. Let's say they buy property that's worth less than $1 million, and so they buy property, they buy coverage so that it would cover the estate tax upon their death. It could be something to consider, something inexpensive and practical as well. So you see, there are solutions to the estate tax problem. So another way that clients or non-U.S. investors own property is, as you can see here, you have the NRA, which is the non-resident alien investor. FORCO, that stands for foreign company. Foreign company. So foreign company, when there is a non-U.S. investor and they have assets in the United States, like property, and they die, they're going to have to file an estate tax return and report their U.S. assets, including the real estate, and then they're going to have to pay estate tax on their real estate. Well, foreign companies are not subject to the estate tax. Only individuals are, and this is why, if let's say you have a non-resident, a non-U.S. investor buying property via a company, that's probably, it's probably a good thing, because then they'll have the foreign company will never die, because companies are entities and they never die unless they're closed, but they'll live forever, and so there's no estate tax imposed on that. And there's some pros and cons as well. Ferpta would apply as well, because you have a non-U.S. person, and person could be an individual or an entity, a company, right? So Ferpta still applies. But let's say that you sell the stock of that company. If you sell the stock of that company, Ferpta will not apply, because stock wouldn't be wouldn't be considered what we call a U.S. real property interest. Now, I have seen that happen, and when that is the case, usually if you sell stock of a company, a foreign company that owns property underneath in the United States, it's sold at a discount, because eventually Ferpta will apply, right? Ferpta will apply, and whoever now owns the company will have to pay that Ferpta withholding. And so I'm going to continue on. I have the pros and cons again. Just a parenthesis for companies. If you have an investment in a company, if you have property through a company, the tax is 21%. Right now, as you may have heard, with the new administration in the White House, we don't know what's going to happen. There are talks about proposals of increasing the corporate tax rate to like 28%, and then also the capital gains rates to ordinary tax rates for those making more than $1 million. That's still in the works. We don't know what's going to happen, so it's kind of tough to plan right now. But I think if we're going by the current rules and the current rules, that this is good. And I always tell clients, the advice I'm giving you is really on current tax law. I don't know what's going to happen in the future, but we probably would need to keep an eye on that as well. Okay, so there are tax filings as well. If you have a client that's buying via a foreign company, buying property via a foreign company, there are some tax filings required if the property is being rented. If the property is not being rented, be careful if they're using the property for personal use and the property is owned via a corporation. And that's because there have been some cases. There was a case that came out, I can't remember the name now, but not too long ago, where the IRS said, well, I understand that you are the owner of the company, but you use the property of the company to live, you vacation there. Well, you basically didn't pay, you were supposed to pay the company rental income, like rental. There was no lease or anything. So they came and they imposed tax on the deemed rents received by the company. So it became a whole big, a problem basically for the investor. And so that's why I would say be careful with having a foreign company own personal use property and no rents being paid by the owners who are using the property. Let's see. Oh, okay. So here's the name of the case. I think the exhibitor. I think that was the name of the case, or the company in the case. You can actually, if you go to that link, you can find an article about it and learn more about what happened in that case. So, okay, okay, this looks very complicated, but there is a way if you have clients who are non-US investors and they're buying property to use for their personal use, there is a way that they can still protect themselves from the US estate tax and use a property and not pay rent to themselves. You know, but you know, if you have that situation, I'm happy to speak with you when that arises. Okay. So there are some tax filings. I mean, with everything, I would say that for anything, you know, anything that your clients are buying, assume there will be some tax filings, whatever it is, unless you're buying something, you know, in their own personal use. I mean, let's say that they're buying something in their own name and they're using it for their personal use. Okay, maybe in that instance, there may be no tax filings. But in general, if they set up an LLC, if they have a company in between, if they're renting the property, even if it's in their own name, you can assume there will be some tax filings, okay? This is another structure where you have a non-US investor owning a foreign company underneath, and that foreign company owns a US LLC, and then that US LLC owns the US real property investments, right? Whatever the property is. In this case, it's similar to what we were talking before. You still have the foreign company, you still have the US LLC. The US LLC is owned by one non-US person, so we still have that Form 5472 filing requirement. And any transactions between the foreign company and the US LLC will be reportable. You still have that $25,000 penalty if you don't report that. But then, you know, in this situation, since the non-US investor owns the property via a foreign company, you basically are protected from the US estate tax, right? So the US LLC, just so you know, and I'm sorry I didn't explain this before, a US LLC is what we call a disregarded entity. Disregarded, basically ignored for tax purposes. Legally, it exists. It gives you protection from liability, but for tax purposes, it's like there was nothing. You know, if you say you own an LLC, you would any activities within the LLC would be reportable under you, under the owner of the LLC. So in this case, the US LLC in this structure is disregarded, basically transparent. And so any activities within that will flow up to the foreign company. So this is similar to what we were talking earlier, stock of that foreign company. If you sell that stock, not subject to Ferpta, but if you sell the property, that's going to be subject to Ferpta. So I'm going to just continue on for a little bit more. Tax filings, yes, there will be some tax filings for that structure. Now, I want to get to this because this is important for what we're talking about here regarding Ferpta. If you have a situation where you have a non-US investor that owns a foreign company and then owns a US corp, because we have a US corp in there, generally what I have seen, which is not really correct, but I'll tell you what people are doing. That US corp, if that US corp sells the property, there won't be any Ferpta withholding. And there won't be any Ferpta withholding because you're dealing now with a US person, a US company, okay? And so that's why you may see that you may have clients that are saying, no, I'm setting up a US corporation, and that's gonna be the owner of this property I'm buying. But it's really important that between the non-US person owner and a US corp, there is either a foreign company or an irrevocable trust. And I don't have the structure for a trust here, but that's another solution as well, because a foreign company or an irrevocable trust, they won't be subject to the estate tax, which again, like I said earlier, it's 40% of the fair market value at the time of death. So it's a lot. I know we're getting close to 45 minutes. So let me go to a few more things that I do want to go over. I have a lot of slides here, but I mean, you'll see these. I do want to get, I mean, we spoke about Ferpta a little bit. Again, Ferpta is a withholding. Ferpta is not an additional tax, it's a withholding that, again, when a non-US person sells property, the buyer is required to withhold 15% of the sales price and remit it to the IRS. And that's really to have the I think it's kind of to force the seller to file an income tax return and report that they sold property in the United States and that they paid, you know, that withholding. And so say, for example, that the withholding, and a lot of times this is the case, is more than the actual tax that they will be required to pay, you know, capital gains tax. Well, they would get that money back once they file their income tax return. They would get that over withholding back. It's like whenever we file a tax return ourselves and we in our W-2s have more withholding, you know, when we file our return, we get our money back, whatever over withholding we had. It's similar to that. So I want to speak about two more things. I'm just gonna really skip through these, but I want to talk about a few things that I think you probably also know. Let's see. So geographic targeting orders. I think you're probably familiar with this as well. When you have clients who are buying property through an entity and they're paying all cash. And so the title companies are required to report back to FinCEN, that's the Financial Crimes Enforcement Network, that this is happening. And, you know, they're doing this for anti-money laundering reasons. They want to see who it is, who are the people buying these properties and trying to hide between an entity, right? And so these are they're called geographic targeting orders, and these are say you have a client that's buying a property through a foreign company or an LLC, and they're paying all cash, right? Millions of dollars, and the title companies are required to disclose the names of these natural persons behind these legal entities. And you know, these are this is happening in all of these cities and you know, in the United States. So these are very popular cities where you have foreign investments coming in. Something else I want to talk in I'm conscious of the time is the Corporate Transparency Act, which actually came into place at the beginning of this year. And that is going to require, we don't really have much information about this, but it's going to require the names of the owners, what we call the UBOs, the ultimate beneficial owners. So if you have a non-US investor who's buying property in the United States through a company, a US company, it could be a US LLC or a corporation, it's going to be required that their names, if they own more than 25%, and I forget if it's 25% or more, if it's more than 25%, but I think it's 25% or more. If they are 25% or more owners of a US entity and they're buying property, I mean, forget buying property, but just in general, we're gonna have to disclose the owners, the names of the persons behind that entity. And this is, again, this is for money laundering purposes. They want to really get to the bad actors. Sorry. So that's my alarm. We are at 45 minutes, and thank you, Emmy. I got your text as well. I'm gonna stop here. I'm gonna take any questions right now.
Alicia, it's Kathleen, we have one question from Shirley Johnson Boyd. She asks, for the US LLC, do you typically recommend an SM LLC or LLC partnership with part ownership in another LLC incorporated in Delaware or Wyoming.
Okay, well, as an SMLC is single member LLC. That's what that stands for. Single member obviously means you have only one member of the LLC. Again, if non-US investors are buying property, and let's say they have the non-US investor is an individual and they're buying, they're setting up an LLC, that again, to buy property, that again, that's actually, let me go back to this. That's, let's see. That's this guy here. Okay, that's number one. That doesn't protect the non-US investor from the estate tax. I mean, that protects them from liability. If somebody, you know, if they're renting the property and somebody falls, you know, that's liability right there. But that if the non-US investor dies, they will still have to pay, the heirs will still have to pay that 40% of the fair market value at the time of death of the value of the property. So so that's question, that's number one. Number two is, do I recommend an LLC that owns another LLC? It depends. I mean, what is the, you know, what we do have that situation, which is actually this, in a way, we kind of have that situation. I mean, which is, let's see, this guy here, but that requires a lot of, you know, we would need to revisit what is the purpose, what is the client, what do they want to achieve, right? That's number one. Why are they investing in the US? Does it make sense for them to have multiple entities? And so, you know, that's going to be, and there may be some check the box elections that we need to do, even if we set up, let's say, a multi-member LLC. There may be a requirement. We may have to do a check the box election. What that means is we check the box, we do this paperwork that basically says, well, we are a partnership, but now we want to be considered to be a corporation for whatever, you know, for X reason, right? It's most of the time it's for tax purposes. But I think whoever asks that question, I think, you know, I have more questions for you to be able to really answer your question. So I'm happy to answer it offline, to go over your facts a little bit more in detail.
Thank you. Tony Danziger asked, how can you get an exemption from Ferpta Withholding? Or what was the other question there? Also another, is there a minimum threshold where Ferpta does not apply?
Okay. So
Yoshi, can you put on mute?
Oh, sorry.
Thank you.
Okay. So yeah, I mean, that's a good question. And there is an exemption for Ferpta. And that's what I was talking earlier about, the withholding certificates. So say, for example, you know, remember my client who sold that apartment in New York City for, who bought it for $5 million and sold it for $4 million in 2020, just because of the market conditions, right? Obviously, if you take 4 million less 5 million, it's $1 million loss. So there's no capital gain there. There's actually a loss. So the Ferpta withholding is required whether there's a loss or a gain. But if there's a loss, or even if the capital gains tax will be less than the actual Ferpta withholding, there's a mechanism that we can do to reduce the withholding or even eliminate it. And that mechanism is, number one, we have to apply with the IRS. We have to send an application, and that's on a form 8288-B, B as in boy. And that application, it's really, I mean, it looks really simple, page 1, But we have to attach a whole bunch of things. We have to attach the sales contract to show how much the property is being sold. We have to attach the calculation of our adjusted cost basis, right? We have to show that we actually bought the property for what we're saying we bought it. We have to show a calculation of how much the tax will be on that on the sale of that property. If there was a loss, we would show that it's zero, but we actually have to calculate it ourselves. We have to also on that form, there's a question that asks, have you filed returns in the prior 3 years, right? I mean, that sometimes is a problem because sometimes clients haven't filed returns and maybe they've been renting the property and they haven't filed returns. And also that one-page application asks at the end when the investor signs it, on the penalties of perjury, you're saying, you're answering all of these questions correctly. Well, the problem is if they were required to file tax returns, because I think the question is, were you required to file a tax return and did you file for the past 3 years? That's a problem if they haven't filed returns, right? But anyways, but yes, we can apply for a reduced withholding certificate. But it takes time to put that package together because there's a lot of paperwork. It's like, that goes to the IRS, and it has to be done before the closing of the property. And if it's not done, the IRS will automatically reject it. So, we have some time constraints. And what normally happens is, let's say that the seller wants to do that reduced withholding certificate application and the buyer agrees. Normally what happens is the buyer's attorney keeps that withholding amount in their escrow, right? Because it's their responsibility. And they wait until the IRS processes that application, and when they get the response from the IRS, and if the IRS says yes, we accept your application, the buyer's attorney releases the funds to the seller. If they say no, we don't accept your application, you still have to send us the withholding, then the buyer's attorney sends the withholding to the IRS. So there's a process. The buyer has to agree as well to do that. Because otherwise, and what I see a lot of the time, buyers are reluctant to do that because they don't want to they want to just get it done, right? They want to just buy the property and just forget about that and just get it done. Because sometimes, and by the way, the IRS, especially now with COVID, there are so many delays. So I have a client that it took them a year to receive almost a year to receive a response, So we have to be very patient, and we have to have a willing buyer to be able to do that as well.
Thank you. Someone asked, would a trust for clients with the U.S. and overseas properties make sense?
I would say if you have a non-U.S. investor and they're setting up, if they have a trust, I would say isolate the U.S. investments from the non-U.S. investments. I think that will be the best thing to do, because then you don't have assets that could be caught up in the U.S. tax system that are not in the United States.
Thank you. And you just touched on this earlier, but someone asked, is it taking longer to apply with current conditions? How long does it take?
Yes. So yes, as I mentioned earlier, even before the pandemic, the IRS was very short-staffed, right? And they are hiring people. I mean, the good news and the bad news is that they are hiring people. It takes them some time to train these people. It takes them a few months, but we have more people that are going to help us. However, and why is that bad? Well, bad because we're going to have more clients who are going to be audited, and they're going to be getting notices. And I mean, for me, it's wonderful because I'll have more work, but our poor clients are going to be, they're going to have a lot of anxiety. But why is it taking more time? Well, yes, because the IRS had shortages and probably still does And also the pandemic, people, the IRS, they were working from home and they were not really going to the office. And all of these applications for reduced withholding certificates or anything, any Ferpta related documentation is done by paperwork, by actual, we send in the paperwork to the IRS. There's nothing electronic about it. Everything, you know how we can e-file tax returns. This is not e-fileable. These things are not e-fileable. We have to actually send mail to the IRS. And so if there were no people checking mail, or they were checking mail once a week, that's going to cause even more delays. And how long is it taking? Well, I think the IRS is catching up, but it is taking a while. Maybe now they may be down to 6 months. Before they were taking, I know, for around 10 months to process these. But they are slowly catching up.
Thank you. What are the exceptions for Ferpta?
So there are some exceptions, which I didn't go over, but say, like I said, if they were, for example, if there's a U.S. seller, Ferpta wouldn't apply. So that's why a lot of non-U.S. investors set up U.S. companies. That's not entirely correct, but and I'm not going to go into that. But generally, yes, if you have a U.S. corporation and you're selling property via that U.S. corporation, because the U.S. corporation files tax returns, there wouldn't be any Ferpta.
Thank you. Do we have any other questions?
It looks like we don't.
Yeah, it looks like we're at the top of the hour.
You have been amazing, and we thank you so much for sharing your wisdom with all of us. If you can, and add to the chat your contact information, at least, we do encourage everybody to visit our Global Business Council website. I put it on the chat. And also, Tony will be announcing our next events. So stay tuned, and we're looking forward to see you all pretty soon. Thank you so much, Alicia.
Oh, thank you. Thank you to everyone. Thank you for staying all this time.
Thank you. Very, very informative. And before everyone leaves, thank you for joining us. This was a great informative event that we had. We want to educate everyone and expand our network. So thank you to all of our audience members from all the different states in the country and also around the world. I invite you to join us for some other events that we're going to be having. Our next one will be our global chat with the state of Texas. So typically we focus on another country. On August 3rd at 10 o'clock a.m., we're actually going to be doing our global chat series focusing on the state of Texas and how foreign investment is coming into the US. So that's going to be a really interesting global chat we're going to be doing. Also, if you are going to be attending NAR's C5 Summit on September 27th through September 29th in Manhattan, we invite you to stay one extra day to join us for our Global Real Estate Summit, which is going to be held at the same location at the Marriott Marquis Hotel in New York City on September 30th. We are joining with other real estate associations in our region, including the Greater Bergen County Association of Realtors, Staten Island, Long Island Board of Realtors, and 3 or 4 other associations as well. We're also getting sponsorship from other associations, including in Texas, Canada, and NAR. So we want you to stay that one extra day. If you're going to the C5 Summit, please send us a message in the chat box. We'd love to reach out to you and give you more information on how you can also attend our global summit in Manhattan on September 30th.
Okay, so thank you all, and have a wonderful rest of the week.
Thank you.
Thank you.
Thank you so much.
Thank you.
Excellent program. Thank you, Kathleen.
Oh, thank you, Ahmed. Great to see you.
You too. Hi, Tony.
Thank
Take care.
you.
Bye-bye.
Thank you, Ahmed. Katrina, I don't know if